All right, picture this. When the markets crash, almost everyone immediately hits the panic button, right? But history actually reveals this really crazy, paradoxical reality. A lot of the world's absolute greatest fortunes were not built during massive economic booms. They were actually built during recessions. So, welcome to this explainer. Today, we're diving deep into the wealthy mindset, and we're going to unpack the exact step-by-step strategies that smart investors use to build serious wealth, even while the headlines are just screaming fear. So just imagine this scenario for a second. It's early morning, you're pouring your first cup of coffee, you casually glance at your phone, and bam, you wake up to the news that the stock market has just tanked another 10%. It is terrifying. You turn on the news, and the channels are just completely dominated by bad headlines, flashing red tickers, absolute worst-case scenarios. You open social media, and it's this endless barrage of predicted disasters. Literally everywhere you look, it feels like the financial sky is falling. And look, we all know this isn't just numbers flashing on a screen. It bleeds into the real world, and it happens fast. Companies start actively laying off workers. The businesses right in your own neighborhood might have to close their doors. There is this palpable, real-world anxiety out there because, people are genuinely afraid of losing their jobs and their livelihoods. The whole economic engine just seems to grind to a sudden, violent halt. For most families, a recession essentially turns into a frantic, panicked scramble for financial survival. When your income is threatened, your natural instinct is to protect whatever you have left, at absolutely all costs. The emotional toll of that is incredibly heavy, and your focus instantly narrows down to simply, how are we getting through this week or this month? But that brings us to the million-dollar question, doesn't it? What exactly do the rich do differently when the economy seems to be falling apart? Because I'll tell you, for wealthy investors, a recession feels entirely different. Now, don't get me wrong, they aren't popping champagne and celebrating the downturn, and they certainly aren't just ignoring reality. Instead, they are completely calm, and more importantly, they are preparing. They deeply understand one simple historical truth. Recessions just don't last forever. Every single major economic crisis eventually ends, and the people who prepare during these really difficult times, well, they're the ones who benefit the most when the recovery finally kicks in. The very first difference we see between the average investor and the wealthy investor isn't actually about the money itself, it's all about mindset. While their friends are out there panic selling and constantly asking, oh my gosh, how much money am I losing today? The wealthy know that emotions are incredibly expensive. They don't obsess over today's losses. Instead, they patiently ask, what will this investment be worth 5 or 10 years from now? Patient investors stay relentlessly focused on their long-term goals rather than just reacting to the short-term fear. So to understand how they actually execute this, we can break their approach down into 3 distinct phases. Let's start with phase 1. Financial defense. Because, let's be real, you can't go hunting for growth if your financial foundation is literally crumbling beneath you. There's this super common misconception that wealthy people just invest every single dollar they have all the time. But in reality, they operate completely differently than someone who is 100% fully invested. They almost always keep cash or highly liquid assets ready to go. Why? Because recessions put businesses and real estate on sale. Having cash sitting there doesn't automatically guarantee a profit, sure, but it provides something invaluable, the total flexibility to strike when the iron is hot. Which leads us to the crucial next defensive move, avoiding unnecessary debt like the plague. Debt becomes significantly more dangerous during a recession. The wealthy specifically steer clear of excessive high-interest consumer debt for one very good reason. While your income might suddenly become uncertain, your interest payments absolutely do not. By keeping their financial pressure low, they can make highly calculated, much better decisions, rather than desperate, emotionally driven ones. All right, so once that rock-solid defensive foundation is set, we move right into phase 2, financial offense. This is where the wealthy go shopping, and I mean strategically shopping. When markets fall, pretty much everything goes on sale, but they don't just blindly grab anything with a discounted price tag. No way. They meticulously target quality assets. They hunt for financially bulletproof companies that have consistent earnings, totally manageable debt, reliable products, and really strong leadership. So instead of chasing those fleeting short-term trends, they are buying solid value that lasts. But, and this is a big but, they never ever put all their eggs in one basket. Spreading their investments across stocks, bonds, real estate, and cash builds a deeply resilient portfolio. In fact, if you look back at the 2008 crash, the folks who stayed diversified across different asset classes actually recovered their losses years faster than those who gambled everything on just a single sector. Diversification doesn't completely eliminate risk, obviously, but it acts as a phenomenal financial shock absorber if one sector happens to take a massive hit. Now, while a lot of people just sit on the sidelines waiting until the economy, quote-unquote, feels safe again, the wealthy practice consistent investing over time. That means putting money into the market through both the good times and the bad. The catch here is that markets often recover long before the actual news cycle becomes positive. So disciplined investors just maintain their plan rather than trying to perfectly time a market bottom, which, let's be honest, is something absolutely nobody can reliably do. And part of playing a good, disciplined offense means you have to understand and manage risk. They evaluate potential downsides really carefully, and they ask with genuine curiosity, okay, what could go wrong here? Can I actually afford to take this loss? And how does this fit into my overall game plan? Good investing isn't about avoiding risk altogether. It's about fully understanding it and managing it strategically. Which finally brings us to phase 3. And honestly, this is the real secret sauce, the decades mindset. This final phase entirely shifts the focus away from financial capital and onto human capital. See, money isn't their only investment. During those slower economic periods, the wealthy actively invest in themselves. They're reading books, taking courses, mastering new technologies, building side businesses, and expanding their professional networks. During a downturn, taking the time to upgrade your own skills is literally one of the highest return investments you can ever make because it's going to compound for years and years to come. And that leads us to a very powerful number, 10. 10 years. The single biggest difference between the average person and the wealthy is their perspective on time. While so many of us measure our success by, this week's stock price or this month's portfolio balance, the wealthy are thinking in decades, not days. They're constantly asking themselves, all right, what industries are actually growing? What trends are truly going to matter over the next decade? Adopting this long-term mindset just immediately kills emotional decision-making. Those scary, flashing red news cycles completely lose their power when you view them through a 10-year lens. You literally stop panicking about today, and you start actually preparing for tomorrow. Now, I know all of this relies heavily on patience, a trait that is, let's face it, in incredibly short supply these days. We all want the quick answers and the overnight profits, right? But true wealth isn't a microwave dinner. It absolutely requires compounding. Businesses need time to innovate, and markets just need time to heal. Patience is exactly what helps investors completely avoid making those terrible decisions driven purely by panic. Because at the end of the day, here is the absolute truth. Every single recession eventually ends. The wealthy don't have some magic crystal ball or a secret formula hidden away. They just approach the difficult times calmly. They keep their emergency fund topped up, they avoid bad debt, and they stubbornly hold on to a long-term plan for the inevitable recovery. So that leaves us with one incredibly vital question for you to chew on. The next time you wake up to terrifying headlines about the markets crashing, will fear make you sell, or will knowledge help you prepare? Remember, the goal here isn't to perfectly predict the next crisis. It's to be ready for it when it hits. Thanks so much for joining us for this explainer, and here's to building a much more resilient mindset. See you next time.